Hi there, and welcome to The Street here on BNN Bloomberg. I'm Paul Bagnall. Thank you so much for joining us this morning. On today's show, we'll talk with an investing professional about the remarkable surge in U.S. stocks. The S&P 500 hasn't rallied this hard in such a short period of time in 75 years. Our featured guest will also talk to us about the weakening U.S. dollar and big U.S. tech stocks. She thinks it's another reason to stay invested in technology. Finally, we'll speak with David Rosenberg this morning. He, of course, is a prominent Canadian economist. Scam artists have been using his name and image on social media, and he wants to talk about it. Finally, we want to hear from you this morning. In our first call segment at the end of the show, we'll invite you to ask questions of our featured guest of the morning. She's Brianne Gardner of Velocity Investment Partners, Raymond James. So get ready with your questions on North American large cap stocks. We'll have Brianne answer as many of those as she can. The number to reach us at will be 1-855-326-6266. We'll open the phones in about half an hour from now and be ready to take your questions very shortly after that. In the meantime, you can send us a question right now by email. That email address is firstcall@bellmedia.ca. Let's get started now with some stories that we're watching for you here in the BNN Bloomberg newsroom. Shares of Sandstorm Gold are trading higher in U.S. pre-market trading. Royal Gold has agreed to buy Sandstorm in an all-stock deal for an implied value of $3.5 billion. Royal Gold is also buying Horizon Copper for an all-cash deal worth $2 a share. Royal Gold holders will own a majority of the combined company when the deal closes. Shares of Tesla are trading lower in the pre-market after U.S. President Donald Trump slammed Elon Musk's decision to start a new political party. Musk said over the weekend that he launched his new America Party the day after Donald Trump signed a tax cut and spending bill that Musk has been very critical of. Musk's latest signal toward a long-term commitment to politics could discourage investors who have been frustrated with his political activity in the past and want him to focus more on running his companies, including Tesla. Let's take a look at the U.S. futures on this Monday morning. Of course, it will be back to trading for U.S. markets today after trading did not take place on the Friday, July 4th holiday. There you see a mixed picture thus far in the U.S. pre-market. And now our top story. The S&P 500 has surged by 26% over the past 3 months. It's been a dizzying time for investors who, not that long ago, were worried that U.S. trade tariffs would put the brakes on global economic growth and on stocks. Let's talk about it with our featured guest of the morning. She's Brianne Gardner, wealth manager and investment advisor at Velocity Investment Partners, Raymond James. Brianne, first of all, thanks for joining us. It's great to have you along with us on the program today. What do you make of this remarkable rally? What do your clients have to say about it? And what are you telling your clients about this dizzying rally we've seen since the beginning of April?
Yeah, thanks for having me as always, Paul. And as you mentioned, for the S&P 500, this is the fastest recovery or fastest bounce that we have seen in 75 years, right? More of a V-shaped than that U-shaped recovery that we have seen in more bearish situations. So for us, that was a little bit of a reset from a valuation perspective. We did see the S&P 500 just deliver the fastest rebound from a 15% drawdown, again, in over 75 years, needing only 55 trading days to recover from the April tariff driven bottom that we did see, and now into the beginning of July. And that rebound did beat the previous 1998 record, which came in the aftermath of really that Russian debt default crisis. And it also stands out even more when compared to the historical average. So if we look at the average recovery time of these types of sell-offs or of these types of pullbacks in the market, it only took 89 trading days to reach a new all-time high after the February peak. Usually on average, when we see the market pull back in this type of recovery, it takes about over 360 days. So 360 versus 89 is definitely a drastic difference, and really a reminder to investors of how quickly markets can reset once fear starts to fade. So I think for us, what's encouraging is that this bounce wasn't just driven by technology or the Magnificent Seven. We've really seen a broadening out and broader participation across industrials, financial sector, and even some early signs really in the cyclicals showing us this full participation, which can continue to see things go higher. And really technically, the market just flashed a golden cross, a technical indicator that we do watch, which really is a bullish signal that often points to continued strength in the months ahead. So things that we are watching and things that, we continue to watch is the economic data that is coming out. I think rate cut expectations starting in September for the US, now nearly a 70% odds, along with better than feared, earnings and ramping up again into another earnings season, and stable inflation, I think have helped ease a little bit of these concerns from investors that we were potentially going into a recession in the US at the beginning of the year.
We'll talk about multiples on the S&P 500 and US stocks more broadly in our next conversation. But do you think the news that we've had on tariffs justifies this type of rally? The narrative is that the markets were very concerned about what tariffs would do to the global and US economies, and now are much more comfortable with the idea of trade deals being reached. Do you think we know enough about where this is going to have justified the huge rally?
Yeah, I think there's still definitely risks that remain in the market, especially around valuations, as you mentioned, Paul, and geopolitical risks and concerns there. But I do think that the speed of the recovery tells us that there's still plenty of cash on the sidelines. And we did know that last year headed into 2025, and really a strong appetite to kind of buy the dip on a lot of quality names. I think after the brief pullback we did see in April, really driven by those tariff headlines, I do think that, yes, there was a lot of uncertainty of what these tariffs would mean. And as we got additional information and clarity of, Trump was coming to the table to make deals and wanting to make deals, and so were other countries, I think that we were starting to see the markets react. And again, it is important for investors to remember that the economy and the stock market are different, right? And the market is forward looking. So it has priced in a lot of that trade uncertainty, that trade fear that investors were feeling when we did see that April sell-off. So trade tensions definitely still remain part of the story. I think so far only China, the UK, Vietnam have really reached core agreements. And even those aren't fully settled to this day. I think China has already expressed concerns over the Vietnam deal, and talks with Canada, a little bit remains stalled. So I think right now we're looking across the board that the average tariffs now are around 16%. So that's roughly $2,000 in annual cost to households. So that can be a lot of money to a lot of people, right? And to the average investor and to the average Canadian. So we're starting to see pressures on consumer activity, though not enough materially yet to shift the growth trajectory of the full economy. So again, things that we are watching, but right now we haven't seen that full impact of what the tariffs will have on the economy.
That's Brianne Gardner. We will take a short break, and when we come back, we'll continue this conversation. Brianne will show us the numbers on PE multiples on U.S. stocks versus world stocks right after this. Welcome back. Let's take a look at the markets, an expanded view of the markets, and we'll begin again with the U.S. futures. After trading was paused on Friday for the July 4th holiday, that's the view of the futures market. The Dow Jones Industrial Average futures market flattish. The NASDAQ 100 futures contract and the S&P 500 futures contract are down. We will continue to track them, of course, right through the open of 9:30 a.m. Eastern Time. Here's how major Asian markets concluded the trading day. Tokyo down by half a percentage point. Hong Kong down by about a tenth of a percentage point. The CSI 300 in Shanghai down by close to half a percentage point. On a year-to-date basis, Tokyo's up by about Tokyo's actually down by about 3/4 of a percentage point. The star performer here is Hong Kong. It's up 20% so far in 2025. The CSI 300 in Shanghai is up by about 3/4 of a percentage point. Here's a look at the actively trading European markets. London is flat, while we have solid gains going in Paris and in particularly Frankfurt. And in this part of the world, it is Frankfurt, which is the star performer. The DAX index is up 20% so far in 2025. Here's a look at the S&P 500 and how it closed on Friday. Flat is the answer. 27,036 points was the finish. Last week was the week, of course, where the TSX Composite traded above 27,000 points for the first time ever. Here's a look at the biggest winners and losers on Friday on a pure percentage basis. H&R Real Estate up by 17%. Allied Properties, another real estate investment trust, up by 4%. On the downside, Ivanhoe Mines, a miner of copper, down by 1.5%. And NGEx Minerals down by more than 4%. Speaking of miners, here's a look at metals and how they are trading today. Gold is down by about a full percentage point to $3,312 US per ounce. Silver is down by close to 2% to 36.44, and copper down by more than 2%, still above $5, however. That's the September contract on copper. The latest trade tariff rumblings from the White House. This is the tariffs put on so-called BRIC countries. Those are developing economies. BRIC stands for Brazil, Russia, India, China, and countries allied with those BRIC countries, according to Donald Trump, would be hit with tariffs. That is causing concern about the future of the global economy, and copper often sells off when those type of concerns become prevalent. Here's a look at crude oil, losing a bit of ground to trade at $66.87 US. Here's a look at Western Canadian Select, the Canadian grade of heavy oil at the last price point, was trading at just below $55 US per barrel. And we are now back with Brianne Gardner. She's our featured guest this morning. She's also wealth manager and investment advisor at Velocity Investment Partners, Raymond James, to talk again about the remarkable rally we've seen in U.S. stocks, and this time from a valuation perspective. And we've got a graph that you've provided us with, Brianne, which shows, in very simple terms, the forward PE multiples on U.S. stocks, the S&P 500. That's the white line on the graph that viewers are looking at right now. The blue line is the forward PE multiple on an MSCI global stocks index. That's a proxy for the global stock market. And as we can see, Brianne, U.S. stocks significantly richer from a valuation point of view. What do you see here?
Yeah, I mean, I think that chart definitely shows a lot there. And I think we're seeing U.S. stocks back to a 50% premium. So for us, from a valuation perspective, we are a little bit cautiously optimistic currently on the U.S. I think seasonally, July is a strong month for the markets. On average, we see the markets up about, 1.2%. But having that big run up that we have seen in April, it wouldn't be surprising to us if we did see another little bit of a correction, maybe a 5 to 6% pullback from here, just to reset things just from that big rally we have seen. So if we're looking at, where do we see the most opportunity? I think right now we are sitting with a little bit of cash in our portfolio, being patient, because the U.S. is looking to be a little expensive based on most of those metrics. And, as you showed too, the S&P 500 trading nearly 23 times earnings versus a long-term average of about 17 times. Historically, valuations at these levels have really preceded major corrections. So we can see, anywhere between in 2008, 2020, obviously you saw that pullback, 36% plus. So I don't think we're there right now. I think this setup is a little bit different than 2008, 2001, 2020, in that those past bubbles were really driven by more structural axes like over leveraging and speculative capital, et cetera. And this time, gains are concentrated a little bit more now on kind of profitable, cash-rich companies with real earnings, and a lot of those big tech growth names and early signs of that AI-driven productivity gains. So yes, there's still concentration risk, and it is hard to ignore for us. I think if we look at even the top 10 names in the S&P 500 now make up nearly 40% of the index. So that's surpassing even the dot-com era levels. So for us, again, that is warranting that caution, because that magnifies both upside and downside risk if sentiment does turn. So for us, that's why analyzing them in the current rally is, this current rally is being powered by expectations, tariff relief, Fed rate cuts, rising government spending, record stock buybacks, and surging retail participation, that many of these do still are still in flux. So until we see a breakdown there, then we would get extremely defensive, but we are certainly cautious right now.
Are you buying on behalf of clients right now, or are you waiting for a pullback, which you have told us you think is certainly possible?
Yeah, we are not really buying unless we're taking profits and see an area of opportunity. We're kind of just, again, being patient on the sidelines with any capital that we do have, and actually looking to raise a little bit more. So some stocks that have had a great acceleration off that April low, we are looking at trimming back to our market weight or to our portfolio weight, and then sitting on that cash until we see a little bit more volatility. And not saying that the market can't continue to go higher from here. We have seen those extremes before, but buying at highs, buying at valuations that are expensive and premiums to us, we just don't see the as much upside. We would rather be patient, even if that means sitting on the sidelines for a short amount of time. So I think we're still waiting, as we talked about earlier. Those trade deals are still unresolved. I think tariffs are still going to weigh on consumption of the consumer, and while AI does hold promise, it's still long-term impact is still being priced in, and there are still risks in that area. So again, we're remaining cautiously optimistic, particularly, as you mentioned, on high quality tech and the industrial sectors, but definitely recognize that there is a need for selectivity. And I do think being active in this type of market when their valuations are high and elevated, that may limit upside if momentum does fade.
That is Brianne Gardner on the richness of U.S. stocks now trading at very, very close to record PE multiples, and outpacing world stocks by several percentage points in terms of the price earnings multiple currently being awarded to S&P 500 stocks. Up next, does a weakening U.S. dollar bode well for mega cap U.S. tech stocks? Brianne Gardner answers that question right after this break. It's time now for On the Radar, a closer look at what a professional money manager is watching in the markets. We're back with Brianne Gardner, wealth manager and investment advisor at Velocity Investment Partners, Raymond James. This time, Brianne, to talk about something you've brought to us, the weakness in the U.S. dollar. Everybody knows about that. It's been weakening since for almost all of 2025 so far. The spin that you're putting on it today is quite possibly a positive tailwind to share prices of mega cap tech stocks.
Yeah, I mean, I think the U.S. dollar, as you mentioned, Paul, has pulled back meaningfully. Intraday, I think it hit 145, but daily highs was around there, 6% lower from its peak. Now, started the year, started the year at 143, now 136. And consensus is about that 138 by the end of 2025, and about 136 to 137 across the board by analysts by the end of 126. So that's just against the Canadian dollar. And I mean, I think it has pulled back meaningfully since these tariffs returned to the headlines. So that does fit the broader tariff-driven narrative. If the goal is to boost U.S. manufacturing in the U.S., a weaker dollar does make exports more competitive. So for large cap tech names with global exposure, a weaker US dollar does lift overseas earnings when translated back to US dollar. So for example, if we're taking Apple, Apple's right now is forward PEs about 30 times. They earn nearly 60% of their revenue overseas. And I know we have seen Trump come out hot and heavy on a lot of these big tech names saying, you need to build your stuff in the US if you want to continue to do that. And a lot of them have been trying to put their foot down because they've been able to get such cheap prices over there. But is the tariff going to be worth it? So I think Microsoft has raised guidance in the past quarter due to really their FX tailwinds, especially in their cloud. Salesforce, for example, a stock that I like right now, has been benefiting from strong demand in Europe and Japan, where currency moves definitely can lift reported results. So for us, other reasons really why tech is set to benefit. I mean, I think if we look at margin levels of those names, high margin tech products like software, cloud services do see earnings lift quickly from even modest FX tailwinds. So Nvidia, Meta, Apple, Amazon, etc. Same thing if we look at the cash reserves of these big names. Large cap tech firms hold significant foreign cash reserves on their balance sheets, which can gain value in US dollar terms when the dollar does weaken. And I think finally, really low import sensitivity. So tech sells globally, right? But it isn't exposed to import input costs. So that makes the FX transaction more impactful.
How much tech exposure do you think investors should have right now, or how should an investor think about that question?
Yeah, I mean, I think it all depends too on volatility exposure, comparing to benchmarks, risk tolerance. I think for us, across the board from a risk tolerance perspective in the tech sector, I think if you're anywhere between kind of that, I would say on the higher end or the lower end, maybe 12 to 18%. When you start getting into that 25%, I think you're taking on a little too much. And from a concentration, again, we're seeing that broadening out as I talked about in the last segment. So I think diversification will be key, but I still see a lot of upside in the tech sector. And again, this AI development that is continuing to be profitable, and we don't see that going anywhere anytime soon. I mean, even if we think of the US dollar versus the world, year to date, it's down over 10%, I think down 10.5. 3 months since the tariff day, it's down 6%. So, people, for us, hedging currency is important. I think looking at also picking up USD right now isn't a bad time for investors if they are talking about traveling or going to the US. It wouldn't be a bad time to be picking up US dollars. So it is kind of back to that 2021 or early 2022 levels if we're looking at a value perspective. It's still above the long-term average, but after the drop we've seen in January, just barely, we think it's fairly valued. And according to JP Morgan, it is a little bit overvalued was the expectation. So the USD is still a dominant currency across the world. We don't see that going anywhere. And in global trade, that is continuing to be front and center in talks and in finance. So I think while most of the macro picture still matters, FX tailwinds combined with really strong execution do add another reason to stay constructive on select U.S. tech names.
That's Brianne Gardner. She's our featured guest today. Still ahead, an Indigenous-led private credit investment firm focused on housing development for Indigenous communities across Canada just launched in this country. We'll have more on it after this break. And our phone lines will open soon for our first call segment. Get ready to call us at 1-855-326-6266 or send us an email right now to firstcall@bellmedia.ca. Shares of Sandstorm Gold are trading higher in U.S. pre-market trading. Royal Gold is buying Sandstorm in an all-stock deal for an implied value of $3.5 billion. Royal Gold is also buying Horizon Copper in an all-cash deal worth $2 per share. Royal Gold will own the majority of the combined company when the deal closes. Shares of Tesla, meanwhile, are trading lower in pre-market trading. You can see they're down by about 6.5%. This comes after U.S. President Donald Trump slammed Elon Musk's decision to start a new political party. Musk said over the weekend that he launched his new America Party the day after Donald Trump signed a tax cut and spending bill that Musk has been very critical of. Musk's latest signal towards a long-term commitment to politics could discourage investors who have historically wanted the CEO to focus more on running his companies. Toronto investment firm Global Live and a group of supporters have bought Wealth One Bank of Canada. Global Live teamed up with 6 backers in wealth management and mortgages to buy all the shares of Wealth One. That deal ends uncertainty over Wealth One's future after the federal government raised concerns in 2022 about Wealth One's alleged ties to the government of China. And there is another look at U.S. futures. The Dow is flat, absolutely flat at this moment. The NASDAQ 100 and S&P 500 contracts are trading down. Well, Indigenous-owned firm Kiwayan Capital is Canada's first private credit fund, who certainly launched that fund, focused entirely on accelerating the development of housing in Indigenous communities around the country. Let's hear about it from Tracy Smith. She's the founder and CEO of Kiwayan. Tracy, thanks a lot for coming in.
Thanks for having me.
Tell us about this fund. This sounds topical because housing is at a crisis point around many parts of the country, including on Indigenous communities, and those are both on reserve and off-reserve Indigenous communities. Tell us about the crisis and tell us about the fund.
You know, Indigenous housing has been in a crisis for over 30 to 40 years. And, you know, this is really the first time that Canadians have a chance to participate in a fund like this. Any well-read Canadian knows that Indigenous housing has been in a crisis for a very long time. Picking up any newspaper in this country, you know, every Canadian knows that it's a crisis. So I think now is a time to start to do more to contribute so that the average Canadian can help and contribute to making it not a crisis anymore. You know, the banks sit on billions and billions of Indigenous deposits, but continue to not lend to Indigenous communities to build in more homes, fix the homes that they currently have. And I think now private investors are saying, we want to do more. And that's really what this credit fund is for the accredited investors and investors who have money and are sitting on cash can put this to good work and can actually see these houses being built and see the communities that are impacted by this.
So tell us about the fund. Tell us its name. Tell us how much was raised. Tell us who is in the who has supported the fund thus far.
Sure. So Kiwayan Capital, you know, the name means going home in Ojibwe, which is my roots. So far, we just did our initial close of 10 million last week, and we're looking to raise another 20 to 30 million by September. Some of the investors that have come in so far are Realize Capital, Rally Assets, Denda Capital, the Ta Chain Foundation, and we're really trying to, and Canso Investment Corporation as well. We're really trying to get some strategic investors who are here who really want to impact in Indigenous funding, get a return, but also know that there's a social side to this as well.
Right. Brianne, next question to you.
Yeah, and thanks, Tracy, for joining us. I think given the 44 billion, shortfall in funding and the federal government's, I believe, 4.3 billion allocation over 7 years, what specific policy or funding reforms do you really believe are most urgently needed to maybe meaningfully close the gap or the housing gap in the Indigenous communities?
We understand that the government only has so much in their coffers, right? Government dollars is really the only door that Indigenous communities have been able to knock on, and it's just not enough, and it'll never be enough. And I think the real policy reform needs to come from government to the banks to say, banks, you need to start lending more. You need to start releasing more of your capital assets to Indigenous communities and find a way to lend. It's not acceptable anymore to sit back and say, we just can't lend to Indigenous communities because of the Indian Act and you can't mortgage on reserve. Those days are done. Banks sit on $50 to $100 billion of Indigenous money, and they refuse to lend to end this housing crisis. That needs to stop. And the private investors in our communities who are coming into our fund agree. And our partnership with CMHC, those roots of policy reform around this is going to change. And I hope in the next 3, 5, 10 years, that banks will do more to release the money that is actual Indigenous money back to the community to build more of these houses. And that's what really needs to change in terms of policy, because credit funds like ours, it shouldn't have to exist. When the money's there, it just needs to be lent to the right people.
I assume you or people involved in Indigenous housing have conversations with the banks on this topic. What do the banks say in response?
You know, some of the things that we hear are, well, you know, land can't be mortgaged. We can't repatriate that asset off reserve, so we just don't want to lend. It's risky, and that's there's things called term loans that banks can run out of their commercial areas. They can lend directly to communities. The banks also say this is a small part of our business. You know, it's not worth our time.
Right.
And that's just not acceptable. And I think people need to start having these conversations at high levels in the banks to change that.
Okay. How much can your fund achieve realistically in its early stages?
So right now we're looking at 50 million maximum for this first fund, and then we're already in conversation with pension funds to go for fund 2 to go to a $300 to $400 million fund in 5 years.
That's great. And on the ground in Indigenous communities, how many units can you build?
For this first
how many units can you finance, I guess?
Sure. In this first fund, we're hoping to get anywhere between 150 to 300 units built.
Right. Tell us about a bit about your firm, Keewaydin, and tell us again what that word means.
So Keewaydin means going home, and really that name comes from my roots being Oji Cree from Missinaibi Cree First Nation, and it's really about, you know, satisfying basic needs in Canada. You know, I think most Canadians don't drive by our communities. They're in very remote parts. But the housing crisis is very real and has been for a very long time. And this is all about satisfying basic needs to a good life in this country.
Thanks a lot for coming by today. That's an important story. I'm really glad you came by.
Thank you so much.
That's Tracy Smith, founder and CEO of Keewaydin. After this break, David Rosenberg, the prominent Canadian economist, joins us. Scam artists have been using his name and image on social media. He wants to talk about it. And our phone lines are now open. Brianne Gardner, ready to take your questions on North American large cap stocks. So pick up your phone and call us. 1-855-326-6266 is the number, or you can email us at firstcall@bellmedia.ca. Welcome back. In March of this year, advertisements on Facebook and Instagram started appearing, promising investors or would-be investors big returns on stocks recommended by a man who's one of the most familiar faces in Canadian capital markets, David Rosenberg, the renowned economist. But the ads were fake. They were the work of scam artists looking to steal money from people who came across those ads. And it's estimated that at this point, hundreds of thousands of dollars have indeed been stolen. David Rosenberg reached out to us recently. He said he'd like to talk about this on BNN Bloomberg. And he joins us, as you can see right now. David Rosenberg, of course, is founder and president of Rosenberg Research. David, tell us what's going on.
Well, first, thanks for having me on the show to discuss this, because it really is a public, I'm not so sure health issue, but certainly a public wealth issue. And it's the perils and pitfalls of AI technology, this ability to completely and fraudulently pose as other people. And that includes me for the past 4 or 5 months. Paul, we have the situation that's really getting out of control, where there are these AI bots out there in cyberspace. They are pretending to be me in print, picture, video, on different social media, primarily Facebook, Instagram, I think even TikTok, believe it or not. And they have me in print, they have me in picture, now they have me in video, which they are increasingly perfecting. With me, my firm's logo, some non-existent admin assistant, ready to steal your money. And they're having me on screen with my voice, which is purely fake, either advocating funds, which I'm not running, since I'm not a fund manager in any event. And believe it or not, now they are having me on these sites, on video, advocating speculative penny stock picks. So it's moved from the egregious to the dangerous. Meta is not taking down these advertisements, obviously because it's deriving revenues from it. And that's despite our constant complaining and our constant reporting. And I just spent this past weekend people emailing me, asking me if this is true. Am I really advocating these stocks? Should I be putting my money in these investments that you're recommending, which of course I'm not recommending. So people really have to have an awareness of what's going on, because this fraud is spreading by the day, and the general investing population not paying attention. I mean, the Globe and Mail ran a full page on this 2 weeks ago, and they actually took pictures of me downtown in a green polo shirt. And these AI bots that become so brazen that now they have me in front of the camera wearing that same shirt that I had in the Globe and Mail article exposing all this fraud.
I can attest that I've seen one of these. I was at my gym a short time ago. My trainer and I were talking about this very issue. He went to his Instagram account, found one, and I did indeed see a convincing version of David Rosenberg promising returns, I believe, of 150% in a single month on stocks that he was recommending. So they are out there. They are very much fake. Brianne, I know you want to ask a question of David Rosenberg as well.
Yeah. I mean, just making sure you're the real David Rosenberg we have on the show, not a bot right now. But, I think for investors, it is becoming more and more crucial with the advancement of AI to really verify your sources that you are getting your data from. And, they are becoming so advanced, as you mentioned, David, whether it's print, online social medias, and even now video, that I do think going to, official websites or, emailing or calling to verify, and really a lot of experts, in the finance field or economists like yourself, you're not promoting, you don't see us usually promoting pump and dump or any penny stocks across the street. So I do think that is important for investors to always have that in the back of their mind. But just a question for you from a regulatory standpoint, are you seeing the OSC or CSA or anyone really step in to try and help, reduce some of these other uneducated social media, I don't even know what you would call them, but come out and they're giving advice that they don't even really have any credentials to be giving financial advice?
Well, I don't want to go into too much detail, but authorities are aware. They are looking into it. All I can say is that you can't catch these fugazis. They're like, you don't even know what country they're coming from. It's all basically in cyber. It's like thin air. Once you put your money in, your money is gone. And it's at an increasing scale. My big problem is that Facebook is not taking down these advertisements. And that's the most frustrating part. And they continue to show up and eventually get taken down, but only after these thieves have stolen people's money. And, Paul had mentioned hundreds of thousands of dollars. No, we've actually had people call us up. And what's interesting? These aren't even clients of mine. Why do I sell research? And clients know, I don't do anything on Facebook or Instagram or TikTok and WhatsApp. People can disagree with my market's view. They always have, and that's what makes a market. But I'm a serious guy. If you want to see me, you will see me on other people's podcasts who are equally serious, or you'll see me on my own, on my website. And it's amazing how many people are being duped, and it just won't stop. These aren't clients of ours, but they're calling us every single day. We're fielding dozens of calls, and people are crying. We had one person who put more than $200,000 into some ridiculous penny stock scheme that he got lured into. And there's more and more and more. And I'm having friends of mine and other people in the industry who are coming back to me saying, is this really you? Are you really doing this? So even people that know me well are, thankfully they're not putting money in. But they're asking me about it. But we have fielded dozens of calls. I think we've estimated that at least $5 million has been siphoned off from what they're doing to me. And I decided I went to the Globe, went to you guys. I've got other things up my sleeve. It's not going to stop. This is, again, technology is a wonderful thing, and it creates good, it creates evil. This is the evil part of it.
David, we're going to have to leave that conversation there. Thank you so much for joining us. I'll tell viewers as well that Brian Belsky, another investment strategist, he's with BMO, also has been the subject of fake AI ads on social media as well. Coming up with today's notable call, we've got a review of what analysts are saying on Netflix. That's coming up right after this. Welcome back. It's time now for Notable Calls, when we put the spotlight on what analysts are saying with their ratings and target prices on high-profile stocks. Today, Netflix. It's been downgraded to neutral from buy at Seaport Global Securities. Seaport cites valuation after strong gains in the share price of the streaming company. There you see Netflix stocks over the past year. It's up 91% over the past 52 weeks. Stock has risen also more than 50% off an April low. It's been a big participant in that rally that we talked about with Brianne Gardner. Analyst David Joyce at Seaport says Seaport believes that most of the long-term potential is now factored into the shares at this price, and the company needs time to execute against expectations in advertising, aggregating, launching, and expanding market share. Seaport adds that Netflix has not grown U.S. market share and that the gap versus YouTube TV usage has widened. The downgrade comes ahead of the July 17th release of Netflix's second quarter results. When we come back, Brianne Gardner takes your questions on North American stocks. You can give us a call at 1-855-326-6266, or you can shoot us an email at firstcall@bellmedia.ca. Welcome back. It's time for First Call, when the viewer gets an opportunity to put a question directly to an investing professional. Anita is on the line with a question for our featured guest, Brianne Gardner. Anita, thank you very much for calling. She's calling from Markham, Ontario. What's your question, Anita?
Good morning, Brianne and Paul. Thank you for taking my call. My question is on TC Energy. Is this a good time to get in, or is it I find it too pricey. I own Enbridge and Pembina, and I've been wanting to get into it. It never came to the price that I want it to be. So I need your advice on this, please. Thank you. I'll hang up and listen to you.
Thank you for the call, Anita. So TC Energy, I do like your other two picks, Enbridge and Pembina. Looking at a valuation perspective, I mean, the stock still ranks at 8 out of 10 fundamentally and a 9 out of 10 from a value. Looking at two analysts across the street, I think you're still seeing about 12% upside here, price target of around $73 and a little bit mixed between, buy, outperform, but you are seeing more people, as you mentioned, from a value, shifting more to the hold or underperform. So for me, I don't own this stock. I actually like your other two picks better, and I would stay in those ones. I think even if you're looking at the last quarter of earnings per share estimates and how the stock actually done, they did miss there. So for us, not a stock that we own, and I do like a Pembina and Enbridge over TC Energy.
Okay, thanks, Anita, as always, for your call from Markham. Bob is on the line from Toronto. Bob, thanks for your call.
Yeah, hi, Paul. I'm not happy to hear that you're retiring, but I do wish you the best of luck in your retirement.
Thank you very much.
My question is on freehold royalties. I've been holding it a while, getting a nice dividend on it, bought it around 14, and I'm just wondering if it'll ever see that price again. Thank you.
Yeah, and so you still own the stock? Is that what he said, Paul?
I believe so. I think he's off the line now. Let's assume he does.
Yeah, so I mean, you have seen it a little bit treading sideways, right? Has participated in that April rally as well. From a fundamental, has ranks at 8 out of 10 for us. I think they're acquiring and still managing great a lot of the oil and gas royalties. And I do like the royalty space more, even though it does still include that exploration and evaluating those assets in the petroleum, natural gas in Western Canada and the US. For me, again, not a stock that I own, but it definitely is one on our radar. I see a price upside from here of about 20%. And you can see it has had a strong momentum. And even from a technical standpoint, I see a channel up and it is looking to hold this support. So I would say, yes, I do see it hitting that $14 again, and I would continue to hold that stock.
Okay, let's get one more question in. This one comes by way of an email. Terry wants your thoughts on Capital Power. Brianne?
Yeah, Capital Power. Thanks, Terry, for the question. Capital Power is a stock that we have owned, continue to own, have traded a few times, hasn't fully recovered from that April drawback and has kind of since the beginning of the year been on a little bit of a downtrend. But we are starting to see some momentum change. We have been taking a little bit of profit on it, big in the power producer space, acquiring operating power plants. So for us, looking at the valuation perspective, we still see upside of about 19% from here. So double-digit growth. And it is a stock that we still like. We are a little bit more active in it in making sure we are taking profits off the table. From a fundamental standpoint, I see an 8 out of 10 ranking for us. And again, double-digit upside from here. So we still hold the stock, and I still am a believer in Capital Power.
Brianne, thank you so much, as always, for joining us. And thank you, the viewer, for watching The Streets. The Open is up next.